The word IPO makes investors' eyes light up. It stands for Initial Public Offering. That thrilling moment when a private company finally goes public, allowing everyday investors like you and me to buy shares for the very first time. It sounds exciting, right? You picture early investors turning into millionaires, a stock doubling overnight, and headlines celebrating another market success story. But the truth? IPOs aren't always what they seem. And in 2025, investing in them might be more complicated and risky than ever before. So, should you invest in IPOs this year? Let's find out. To answer that, we need to start with what an initial public offering really is and why companies do it. An IPO is like a graduation ceremony for a private company. It's when a business that has been privately owned by founders, employees, or venture capitalists decides to raise money from the public for the first time. By selling shares to regular investors, the company gets access to massive amounts of capital. That money can be used to expand operations, pay off debt, or develop new products. In return, investors get a chance to own a piece of a potentially fast-growing company. It's a win-win, at least on paper. But here's the twist. The stock market isn't a charity, and IPOs are not always the golden ticket they appear to be. In fact, history shows that most initial public offerings, especially the hyped-up ones, underperform the broader market over time. Let's rewind to the past few years. Remember 2021? It was called the IPO boom. Hundreds of new companies rushed to go public, from tech startups to electric vehicle manufacturers to cryptocurrency exchanges. Investors were euphoric. Everyone wanted a piece of the next big thing. But fast forward a few years. Many of those once hot IPOs crashed hard. Their prices fell 50%, 70%, even 90% below their debut price. Why? Because IPO hype is emotional, not rational. When investors get caught up in the excitement, they forget that behind every ticker symbol is a real business that still has to prove itself. So, what's different about 1925? This year, the IPO landscape looks calmer but smarter. After a brutal few years for speculative assets, investors are more cautious. Companies are being more realistic with their valuations. And central banks, after years of high inflation and rising interest rates, are finally stabilizing monetary policy. That means IPOs in 2025 could actually be higher quality, but only if you know how to separate the hype from the reality. Let's break down the pros and cons. The pros of investing in IPOs. First, early growth potential. The biggest attraction of IPOs is simple. You're getting in at the beginning. Think about companies like Amazon, Apple, or Google. Their IPO investors saw astronomical returns over time. Getting in early on a great company can be life-changing. It's the dream every investor has to catch the next big winner before it becomes a household name. Second, diversification. IPOs allow you to invest in new industries, new technologies, and new business models. In the year 2025, we're seeing initial public offerings in areas like artificial intelligence, renewable energy, fintech, and biotechnology. These are the sectors shaping the future economy. So investing in the right initial public offering could give your portfolio exposure to tomorrow's biggest trends. Third, liquidity for insiders. Now, this might sound like a benefit for the company, but it can also signal maturity. When founders and venture capitalists are ready to cash out, it usually means the business has reached a stable point of growth. It's a sign the company believes it's ready for public scrutiny. That's not always bad, but it's something to analyze carefully. The cons of investing in IPOs. Now, let's look at the darker side. The part most marketing brochures do not tell you. First, information is limited. When a company goes public, it doesn't have a long track record as a listed firm. You can read its prospectus, but that's often filled with optimistic language and complex financials. You are betting on potential, not proven results. Second, early valuations can be inflated. Investment banks and insiders have a strong incentive to price shares high. After all, they want to raise as much money as possible. And who ends up paying that premium? Retail investors, people like you and me, who buy the hype. Many IPOs pop on day one, but then quietly fall in the months that follow. It's called the IPO hangover. And it's real. According to multiple studies, most IPOs underperform the broader market within their first 3 years. Third, limited access for retail investors. Most of the best-priced IPO shares are allocated to institutional investors first. By the time the stock hits public trading platforms, it's already been bid up by big money. That means regular investors often enter at inflated prices, not at the original offering price you see in headlines. Fourth, lockup periods. After an initial public offering, company insiders can't sell their shares for several months, typically 90 to 180 days. When that period ends, there is often a flood of selling pressure, as early investors take profits. This can cause the stock price to drop suddenly, even if the company's fundamentals are fine. That's why timing matters. Sometimes the smartest move is not buying the IPO immediately, but waiting for that first post-lockup dip. Now, let's talk about how IPO investing is changing in 2025. In the past, initial public offerings were mainly for big Wall Street investors. But today, technology is leveling the playing field. Apps and platforms like Robinhood, Fidelity, and SoFi now allow retail investors to participate in IPOs directly, sometimes even at the same offering price as institutions. This is a big shift. It gives more people access to early opportunities. But it also increases risk, because many beginners jump in without doing proper research. So if you're planning to invest in IPOs in 2025, here's what you need to look for. Study the company's financials. Start with the fundamentals. Read the S-1 filing. That's the document every company must submit to the SEC before going public. Look for revenue growth, profitability, and debt levels. Ask yourself, is this business actually making money? Or is it just burning cash while chasing hype? In 2025, investors are no longer rewarding growth at all costs. They want sustainable, profitable models. So be wary of flashy tech firms that have big promises but no path to profit. 2. Understand the industry. Is the company operating in a competitive space? What is its advantage? Does it have a unique product, a patent, or brand power? In industries like AI, EVs, or biotech, new players appear every month. So you need to identify which ones have real staying power. Look for companies solving real problems, not just writing buzzwords. 3. Analyze the valuation. Ask the hard question. What are you paying for? A company might look promising, but if it is valued at 50 times its revenue, it might take years for the fundamentals to catch up. In 2025, the market is more valuation sensitive. Investors want fair pricing. So don't get fooled by media hype. Do your math. Compare the initial public offering's valuation to established peers in the same sector. If it looks stretched, walk away. 4. Check who's behind it. Who are the underwriters? Are they top-tier banks with strong reputations? Or small firms trying to push risky deals? Who are the early investors? If credible venture funds or strategic partners are staying on board after the IPO, that's a positive sign. But if insiders are selling large chunks of their shares immediately, that's a red flag. They might know something you don't. 5. Watch the market conditions. IPOs perform better in bull markets, when investor confidence is high and money is flowing freely. In bear markets, even good companies can struggle after going public. So pay attention to the overall economic environment. Interest rates, inflation, and global demand all play a role. In 2025, central banks are slowly easing rates, which could create a more favorable IPO environment. But volatility still lingers. Patience and timing matter more than ever. Let's use a few examples. Imagine two companies planning to go public in 2025. Company A is a profitable artificial intelligence software firm with steady revenue growth, low debt, and strong partnerships. Company B is a social media startup, promising revolutionary engagement but losing millions every quarter. Which one sounds safer? Exactly. Company A might not sound as exciting, but it has fundamentals. And fundamentals are what create wealth over time. The truth is, IPO investing should be treated like any other investment decision, with logic, not emotion. But unfortunately, emotion is what drives most IPO bubbles. People see headlines like, stock doubles on first day, and they feel FOMO, fear of missing out. They rush in without realizing that early institutional investors are often selling to them. It's called the IPO pop trap. A company might surge 50% on day one, but fall 40% over the next few months. So before you chase the excitement, ask yourself, am I investing or am I speculating? Now, here is a smarter approach. If you really want exposure to IPOs, you don't have to pick them one by one. You can invest in IPO ETFs, funds that track a basket of recently listed companies. These ETFs spread your risk across dozens of IPOs. Instead of putting all your money into a single company, it's diversification for the most volatile corner of the market. Another strategy is to wait 6 to 12 months after an initial public offering. By then, the hype fades, earnings reports start rolling in, and the stock settles at a more realistic price. That's when true opportunities appear. So, what is the bottom line? Should you invest in IPOs in 2025? The answer is maybe, but only if you do it strategically. If you are chasing headlines, buying whatever is trending on social media, or hoping for overnight gains, then no, IPOs aren't for you. But if you're patient, analytical, and disciplined, if you study the business, understand the valuation, and wait for the right entry, then yes, IPOs can be part of a smart portfolio. They can offer growth and excitement, but only when handled with caution. In other words, don't fall in love with the story. Fall in love with the numbers. Because behind every IPO is a simple truth. You're not buying a dream. You're buying a business. And businesses, no matter how shiny they look at first, still need to prove they can make money, survive downturns, and deliver real value to shareholders. So as you look at the year 2025's IPO lineup, ask yourself 3 simple questions. Is this company solving a real problem? Is it financially sound? And am I paying a fair price for it? If all 3 answers are yes, then you might just find the next great opportunity. But if even one answer is no, walk away. Because in the long game of investing, discipline always beats excitement. So take your time. Study the data. Think like an owner, not a gambler. That's how real investors build wealth. And that's how you'll know, when it comes to IPOs in 2025, exactly which ones deserve your money and which ones don't.